So thanks, Hik Chidochi from Ausbil Investments, again joining us for a quick update. So Hik, the coronavirus is still taking its toll around the world. The US announced this morning they're still doing everything they can to bring new cases under control. At the same time, other countries are reporting a reduction in new cases, which is good to see. So whilst the virus hasn't anywhere near been eradicated, far from it, markets have provided investors with some really sharp reversals, as we saw last week, between 10 and 20% net increase, depending on which market. So where do you see this renewed confidence now coming from in share markets especially, Hik?
Good morning, Bill, and hello again, and thanks for having me on again. Usually obliged to give the corporate disclaimer, I'm providing information rather than advice. To answer your question, markets definitely have recovered somewhat from their lows. They do remain extremely volatile. I'd say the main reason for the renewed confidence is that there's been more measures from central banks and in particular governments. For example, on Monday here in Australia, the federal government announced their JobKeeper policy. That was a $130 billion program, which is roughly 10% of our gross domestic product. So the market rallied strongly on the news of this announcement. It's aimed at helping businesses severely affected by this economic downturn hibernate and keep workers employed. This aims to provide an economic bridge, if you will, for the economy, so that on the other side of this, businesses can start up more rapidly again. In fact, in Australia now we've got over $320 billion of both monetary and fiscal stimulus. That's roughly a quarter of our yearly economic outlook. And that's not just in Australia, it's globally too. You were mentioning the US, and this last week they've announced the $2.4 trillion Coronavirus Aid Relief and Economic Security Act. That's a 13% of GDP fiscal measure. These are unbelievable numbers and unbelievable size of stimulus. Total stimulus in the US is now about 4.8 trillion, which is another 22% of their annual output. So, this is really what's giving, markets confidence that there is everything being done possible to support the global economy through this very severe impact of the health measures that have necessarily been put in place. And of course, as you mentioned also, there's been plenty of, positive look at the way that the health crisis has been handled, and maybe a slowdown in new cases in certain localities, etc., etc. I'd have to caution that it's way too early to be confident on any trends there. But so there's been, a bounce back on a little bit more of a glasses half full view on things, and that's been driven by all the support from governments around the world.
Well, we certainly hope everyone's keeping healthy and safe in their homes. Most of us are locked up or working from home, and the world seems to be revolving still, and where there are gaps in economic activity, the governments seem to be propping that up with their stimulus. So that's great to see. Also nice to see some renewed confidence, as you suggest. So we'll let you go. Thank you very much. And next week we plan to talk about basically what drives shares to go up and what makes them go down in layman's terms, because often markets don't respond in real time to sentiments or situations that are unfolding at the same time. So it's a question we often get asked. The world's in great stress at the moment, and yet we're seeing sharp rises, which as you say, are no trend as such. It's too early to say, but look forward to speaking with you hopefully next week, and I hope you and your family are well.
Same to you, Bill, and we'll all get through these quite extraordinary times.
Cheers. Thank you very much. Talk soon.